Hi, good afternoon, good morning. This is Max Schenker, Tax Credit Co. Welcome to the WOTC update. I'm going to go ahead and give just another moment or so. I see people are still dialing in, and we'll get going here momentarily. If people on the line have questions during the course of the presentation, you can use the question box on the GoToWebinar dashboard, and we'll try and get to them either as they're asked or at the end, and if not, then we'll try and address them afterwards. Okay, once again, good morning, good afternoon. This is Max Schenker at Tax Credit Co. in Los Angeles, and we have today a special guest with us for the presentation, Evan Migdale with DLA Piper in Washington, D.C. And we'd like to talk today about the updates to WOTC that occurred at the end of last year with the passage of the PATH Act, what has occurred through the mechanisms of the bureaucracy so far this year, and some of the complications that arose, and some of the things that we'll be doing to address those complications going forward. Again, if anybody has any questions during the course of the presentation, please use the question box on the GoToWebinar dashboard. We'll try and get to those. And so WOTC ended 2015 very strongly. The PATH Act included some major enhancements to the program, most specifically a 5-year extension of the program, which was 1 year backwards to the beginning of 2015, and then 4 more forward years to the end of 2019. That's the longest single extension that WOTC has ever experienced in its history. And the other major expansion of the program was the addition of a new category to target new hires who had been unemployed for long-term unemployed, so at least 27 weeks of unemployment. I think it'll be helpful for us to go through the timeline of what happened between the passage of the law last December and the middle of this summer to get an idea of just what all of the ups and downs in the rocky road that we've experienced this year, what occurred, and then we'll talk about some of the particular challenges with the long-term unemployment category and the paperwork that was introduced for that. And if we have time at the end, we'll talk a little bit about the future of WOTC and tax reform, and maybe a little bit about the implication of the elections. Evan, good morning, good afternoon. Thank you so much for joining us. So first of all, how unique was this extension for WOTC, and how did WOTC fare compared with other tax extenders last year?
Well, as you mentioned, this is the longest extension we've ever had. The closest one was a little over 4 years, which occurred in 2008 or 2006, excuse me. And then when it was first created, WOTC had 3 years. So it is the longest extension we ever had. And in the PATH Act, there were about 60 expired or expiring tax provisions. Of those, a small number of them were actually made permanent. And among the permanent ones were the research credit, some extenders that deal with the structure of foreign transactions for global companies. And then a large number of them, about 32 provisions, were extended only through the end of this year. So our 5-year extension put us in the middle. But it's a very positive thing because it gets us past this year for WOTC in case Congress does not extend the other provisions, which is a battle we're going to have this fall, and we'll see. It gets us into the next administration, and it gets us into the debate over tax reform, which we'll talk down the road. So it was very beneficial to get 5 years rather than 2. We would have liked permanency, but that's something to talk about in the future. But a very healthy extension for us.
Great, and as we mentioned, the other major change to the program was this addition of the long-term unemployment recipient category. So those two events happened in December of 2015. That was what we're calling milestone number 1, the passage of the PATH Act. It took, and just to define that category, so someone would be qualified for the long-term unemployment category, recipient category, if they meet a 2-part test. Part 1 is that they must have been unemployed for at least 27 consecutive weeks. And Part 2 is that during their period of unemployment, they received some kind of state or federal unemployment compensation. One of the things I think that's confusing people is that that unemployment compensation did not have to occur within those 27 weeks. It could have occurred earlier than those 27 weeks if that entire period was a consecutive or continuous period of unemployment. When we talk about milestone number 2, so it took from the middle of December until the end of January of 2016 for the Department of Labor to issue its first kind of instructions to the states about this. Evan, maybe you could just give us kind of a background of the system, the bureaucracy. So Congress passes the laws, and the Department of Labor issues the rules and instructions that each state individual has to use in order to administer the program. IRS plays a role. We saw this year that an organization called OMB played a role. Maybe you could just kind of give us the map of how these organizations work together, and in particular the question is why do the states have to wait until the Department of Labor tells them what to do before they can do anything?
Well, the WOTC belongs to the Internal Revenue Code. It's Section 51 of the Internal Revenue Code, and so the agency that has the primary responsibility for WOTC is the Internal Revenue Service. But WOTC is somewhat unique in that its day-to-day administration is run by the U.S. Department of Labor and the state job services. The IRS's role is to oversee the program, and its regulatory role is basically on the audit side. If you challenge, if an employer's use of WOTC is challenged, then the IRS is the auditor. But the day-to-day administration is given to the Department of Labor. And the Department of Labor itself operates through a bureaucracy. The DOL here in Washington makes the rules, but then those are administered through the DOL to the state job services. And even though those agencies are parts of state governments, they receive funding from the United States government, and on certain programs they coordinate with the United States government. So when a change to WOTC happens, the IRS basically convenes an interagency task force between IRS, Treasury, which is the parent organization of IRS, and DOL to decide how to go about implementing it. And DOL, and they both put out different kinds of guidance. The IRS, for example, will put out guidance in the form of a notice, usually a notice of advanced rulemaking. And so to the extent we'll talk in a few minutes about how the time was extended to do certain things to qualify someone for WOTC, that's a modification of the statutory rules, and so that's put out by the IRS. But then the Department of Labor, when it puts out the longer-term day-to-day rules for administration, they put it out in something called, it's a technical guidance letter called a TEGL or TEGL, and DOL puts those out. However, the TEGLs are reviewed by the IRS before they're issued, because at the end of the day, it's their program. Now, the other part of this is the Office of Management and Budget, and the reason they get involved is that they oversee all federal programs and they oversee all federal forms. And so with WOTC, especially the way it got changed this year, there was a new form, an affidavit form for the new long-term unemployment category, and that had to be approved by the Office of Management and Budget. So we ended up having 3 agencies involved in it. Now, the other issue that comes up here and that Max raised was, what do you do about when do the states react to the extension of WOTC and to how to implement it? And the answer to that really is that they can't do anything until they're advised by the DOL that something has happened. And that's because they are under the umbrella of the DOL, and because the rules are that whatever they read in the newspaper or somewhere else, it does not have any legal significance to the state job services. They wait for an actual official notice from the DOL telling them that something has happened. So for example, if WOTC is simply extended with no changes, which means the program can just continue as it is, the states still don't recognize that until the Department of Labor issues them, usually by email, instructions saying, we want you to know that Congress extended WOTC and you can continue to process it, or you can process it retroactively if it was extended retroactively. But until that happens, they don't react and they don't do anything. So in this case, it got a little more complex and it took a little longer, because not only did the states have to learn that the program had been extended, but there is a whole new category. The new category required its implementation. And you had two agencies negotiating over how to implement the category, how to define it, and that's the new long-term unemployed category. But then they had to create a new form, and they had to go to the Office of Management and Budget, which is why, as we'll explain in a little bit, we got extensions of time, because all of that negotiation, how to implement the new category, ended up taking a lot of time, and frankly just ended a short time ago. But that's basically the scenario. Three agencies have to work together to coordinate and implement a change in WOTC when that change involves a new form or a new category.
And so this communication that the DOL issued at the end of January was not one of these official statements, or I guess it was semi-official. It was really just what they called an interim instruction. It informed the states that the program had been extended and that there was a new category. So not all of the states responded equally to that. Not all of them began to process applications that had been filed during 2015 during the hiatus. Some did and some didn't. And the notice also kind of alluded to what was called transition relief, which is what has occurred in previous years when the program was renewed retroactively, is that the IRS issues transition relief, which is a relief to the part of the statute that says that applications must be submitted to the states within 28 days of the employee's start date. And so they say we suspend that rule for some period of time and allow employers to submit forms going back to the beginning of the retroactive renewal of the program through some date. But that was not official yet at this point. It was just alluded to. And then if we go to the next slide, it was...
Max, let me add one thing. One of the reasons DOL issued something semi-formal was because they got very frustrated with the IRS, and they really wanted to get something out. And sometimes this comes to personalities. The branch chief at the IRS who had jurisdiction over WOTC quit. He retired, which is perfectly all right. But that happened right at the time that the new category was enacted. And so there really wasn't anybody with a lot of institutional knowledge of the WOTC at the IRS. Obviously, someone was picked to step in the shoes of the retired branch chief to work on WOTC, but she's a very good lawyer, but she didn't know much about the program. So I spent a lot of time trying to get her up to speed, but it took a little bit of time. And in terms of the transition relief, this is something we did about 6 years ago, and I negotiated the first transition relief with the Treasury Department. We didn't used to get transition relief, but the reason we did was that the Treasury Department concluded that there are some larger companies that use the program and that have big tax departments and have the money to continue to participate in the program even when there's a hiatus, and that absorb the hiatus into their thinking and their corporate culture. But there are medium companies and smaller companies that, if the program doesn't exist, really don't participate or don't think about participating, and it's a little unfair to them. So a decision was made, I think three extensions ago, to have the transition period to sort of equalize everybody and give everybody an equal opportunity to participate in WOTC. I'm very happy that the transition relief has become a standard in what has been done when WOTC is extended. They've done it 3 times now, so And I'm glad it's become something they do, but it took some negotiating, and we didn't used to have transition relief. We had a lot of extensions, but transition relief is something that's happened just in the last 3 extensions.
Right, yeah, absolutely. And so that didn't occur this time until nearly the end of March. That's when the IRS issued their notice, 2016-22, which explained the new category and also made a formal transition relief. That transition relief allowed employers to submit applications for employees who were hired on or after January 1st, 2015. They had until the end of June of 2016 to submit those, and unless they were part of the new category, and that would only apply to 2016 hires. And at the time, in March, we thought that that looked like enough time. It was a little bit more than had been given last time, I think, to account for the new category, and it seemed sufficient at the time. They also at that time issued a new 8850, which included the new question for the new category, and that's displayed here at the bottom of this slide. That's the new question, which mentions 2 steps, the at least 27 consecutive weeks of unemployment, and for all or part of that period you received unemployment compensation. And that's part of what I alluded to earlier, is that that's not entirely clear that the unemployment compensation could have occurred during a period earlier than the 27 weeks, as long as all of the unemployment was a continuous single unemployment period. That notice also alluded to a possibility of what became the self-attestation form for long-term unemployment. And maybe you could explain a little bit what was the thinking and discussion amongst these agencies, why such a form would be necessary when they're checking this box on the 8850 and the employee is signing that under penalties of perjury.
Well, the truth is we probably didn't need the attestation form. This all went through a very complicated series of discussions. Part of it comes from the fact that it's very difficult to determine whether a person had been on unemployment compensation if the person has basically fallen out of the unemployment compensation system, if people are long-term unemployed. When this category was first proposed, which was about 5 years ago, the 27 weeks had more meaning because it was actually pegged to the standard amount of time that a person could get unemployment compensation. But the rules on unemployment compensation have changed. So the 27 weeks really doesn't have the meaning it used to have. When the category was first enacted and we started talking to the IRS about it, they came back and they pointed out that 27 weeks, in their view, was a null set. They didn't know what it meant. Why did Congress pick 27 weeks? And the answer really was they picked it a number of years ago when it meant something, but it just, the proposal had stayed around and hadn't been modified, and they kept 27 weeks anyway. That led to a discussion of how do you even prove this? And so the IRS went through a long series of meetings with the Department of Labor to figure out, can you, in some of the WOTC categories, you can go into a welfare database, or you can look at a HUD map to determine where somebody lived. And if those elements prove up a category, you can actually prove it up. But you can't really do that here. Because at the end of the day, if you're no longer on unemployment, the system may not prove what you are or not, or whether you ever got unemployment. And according to this, you only had to get unemployment at any period of time during the consecutive period. So there really isn't a database they could work with. The IRS also got into a debate with the Department of Labor about what to do if somebody had temporary, very minor employment. So for example, somebody who clearly is long-term unemployed and clearly doesn't have a full-time job, earns a little income by going out and mowing somebody's lawn or carrying somebody's groceries or doing something like that. But that never gets reported, even though technically maybe it should be, but it doesn't. So what do you do about that? And so we had a long and painful series of discussions about this. Ultimately, we ended up going to Capitol Hill, and we got some of the sponsors of the category, some of the senators who had sponsored it, including Senator Ben Cardin of Maryland or Senator Rob Portman of Ohio, to write back and call back to the IRS and to say, please understand what we're trying to accomplish here. We don't really care if somebody who's really on long-term unemployment earns a few dollars doing something. In fact, we wish they would. I mean, we hope that they can help themselves in some way. but we're concerned about somebody who hasn't had a real job for more than 27 weeks. And the fact that they earned a few dollars doing some odd jobs is kind of irrelevant to their well-being. It doesn't make much of a difference. So ultimately, they settled on the idea of, well, let's let the person just attest to it. And we actually recommended some attestation language. And ultimately, some of that language got on the 8850. And when we first saw the new 8850, my reaction was, that's all you need. Because it's, as Max said, it's under penalties of perjury, and it pretty much says what the statute wants you to say. But the bureaucracies are bureaucracies, and at that point they had gotten into this concept that there needed to be another form. And if you look at the way the attestation form is written, it also pretty much says to the states, if you can find hard evidence, if you can find something actually in the record that proves it up, fine. If not, the attestation form will do. So they got wedded to the concept of having a separate form. And we had a very hard time, obviously we didn't succeed at getting them to knock the second form out and feeling that we didn't need it. We also had a very hard time understanding how the form was written, and we ended up having to make some changes to it because in an earlier version it made no sense at all, and it had to be refined a little bit. So we ended up with an 8850 question that I think satisfies the statutory rules and gives them everything they want, and then a second form. As we go forward with this new category, we're going to try to get the second form knocked out. I don't think it's really necessary, but the bureaucracy focused on it, decided they needed it, and in the end, we didn't want to hold up getting the guidance out this year any longer by having a battle about the form, so we said go ahead and do the form, and we're going to try to get this change going forward.
Right, we'll take a look at that form in a couple minutes, but that's I think an important point, that the story is not yet over. There's still changes that could come and enhancements or fixes to what we ended up with. We, at this point in March, once the IRS issued its notice and issued the 8850, we hoped that the what's called the Teagle from DOL would be short on the heels of that, and we could get moving, especially with the new June 30th deadline for resolving everything. But in fact, it took until May 10th for these new forms, including the historically used 9061 and 9062, to be updated, and for the new form to be submitted to the OMB for approval, and then that took another week for it to actually be approved. So it wasn't until quite a bit later on the short timeline that we had that we got the first look at the form and had those discussions that Evan was referring to. Here, of course, is the form that's now called an ETA Form 9175 from the Department of Labor. A couple of features on it that are of concern to us, and we'll be working on whether eliminating the form entirely or at least fixing some of the pieces of the form. For example, it asks for a date of birth, which is entirely irrelevant here at this point of the process, and is also PII data, and so we try and limit that kind of data wherever we can. And then it asks the employee to actually state the specific date range of their unemployment period, as opposed to just simply stating affirmatively that they had been unemployed for at least 27 weeks. And you can imagine when asking someone for specific dates that are in the past that it becomes difficult for them to answer. Of course, they told us that the employee should just try their best to approximate those dates, but that's hard to explain, and it doesn't always come off. And then in the original version of the form, not only did it ask for specific date range on the unemployment period, but it also asked for a specific date range of unemployment compensation, which is exponentially more difficult to remember and clarify than the unemployment period. And we were successful, I'll say Evan was successful in getting the Department of Labor to step away from that requirement. Nevertheless, this is what we're left with at this point. So this form does not have to be filled out and signed immediately at the same time as the 8850. It could be completed a little bit later, depending on your process. I think we're finding it's more efficient to go ahead and take care of it at during that exact same survey process, where we get the the 8850 completed, and we integrate this question about the specific date range into the survey. Is there anything else we should kind of notice about this form in particular? And then so what was kind of surprising was that even though the forms had been approved around the middle of May, it still took a whole nother month until June 17th before this TEGL that we were all waiting for to be issued from the Department of Labor to the states. And that was what the states had been waiting for. They couldn't move forward. Those states that have automated processes where where application data is uploaded to them, they need to reprogram those systems in order to account for the exact rules of the new category, in order to account for the dates of the transition relief period, and they were just waiting and unable to move forward without this document. So this document ended up being sent just less than 2 weeks before the end of the original transition relief that the IRS had granted. So simultaneous to that document, the IRS issued a new notice and added another 90 days of transition relief to acknowledge and account for the fact that this process had taken an unexpectedly long period of time. And so now where we stand is that the retroactive period of transition relief will end on September 28th of this year. And what that means is that any employee that was hired from January 1st of 2015, an application can still be sent in for that individual until September 28th of 2016, unless it's for the new category, in which case they have to have been hired in 2016. What I'd like to talk about a little bit now is some of the discussion about within that document, within that TEGL, about how, and I think you already started alluding to it, how the states are supposed to go through their process of qualifying that individual. So if an application is sent with or without that additional form, what are the states going to do, or what are they instructed to do in that TEGL for determining the qualification? Evan, are you still with us?
Oh, I am with you. If they don't get the affidavit form?
Well, either with or without, what did the TEGL instruct them to do as far as the procedure that the state should follow to determine the eligibility of a long-term unemployed individual?
Well, they can go look at their unemployment rolls and see if the person is on it. They can actually check their rolls and see if it's in the system. And if they don't, then they have to rely on the affidavit.
And part of the problem is, you know, this period of 27 consecutive weeks, some states might only have data that reflects employment, employment. They will get data with the tax withholdings that show maybe only employment or wages earned on a quarterly basis, and so you can't necessarily break down data that's on a quarterly basis into a weekly basis, and so it wouldn't necessarily be clear whether there was 27 consecutive weeks of unemployment or not. That's one problem. And then if the individual does sign that affidavit, what is the state? How is the state supposed to approach that? Do they take that document at face value, or are they supposed to still try and identify the qualifications through their own data sources? What if they find something that appears to be a contradiction within the data?
Well, if they find a contradiction, presumably they're supposed to go back to the employer and suggest that they're not sure this is correct. But I think what they ended up doing was referencing public files and looking it up and trying to verify it, because they were very uncomfortable with the idea of simply saying they would accept a pure affidavit and they wouldn't look at any public records to see if they could verify something. So if there's any conflict, they're going to raise the conflict. But they also conceded when we talked to them it was going to be very hard to find records. Wage records probably wouldn't tell them very much, and the unemployment records probably wouldn't tell them much either. And a lot of people who are long-term unemployed are no longer on the unemployment rolls, which is in fact why some people claim, and I think they're probably right, that unemployment in the United States is higher than the official number, because the official number tends to look at unemployment records and people drop off of those records when they're long-term unemployed. But I think that they were very uncomfortable just simply saying we'll accept qualification only on the basis of the say-so of the employee. So we're going to go look back at files if we can. But they've conceded they're going to have a hard time finding anything there.
And so, for example, if somebody sends an application in with the affidavit completed, and the state looks up the wage history and can see that wages were earned by this individual from an employer during the last quarter, which would just be a period of 12 weeks or so, then they would see that is a contradiction to the statement on the affidavit and probably deny the application.
They probably deny it and then give the employer an opportunity to respond, which is what you get, and explain that there may be some reason why the wages are earlier in the quarter, or you still have the 27 weeks. But if they see a contradiction, they probably will deny it.
And and as you were discussing, if somebody has some side jobs that are maybe not reported, not through an employer or through an official payroll system, that's one notion. But what if somebody is unemployed and they have one of these kind of small side jobs, but it is reported through an employer, and so it shows up as wages, but they're really let's say de minimis wages? Is that something that the states how are they going to be reacting to that?
Well, I don't think they set up a de minimis rule as such, and it would have been good if they had. But I assume they'll come back and probably deny, and then the employer will have to go back and explain that this was just an odd job and that it is not an indication of employment. I mean, there are a lot of ways to explain that. If the person, as I said earlier, mowed the lawn a couple of times, then I think the answer is it wasn't employment at all because you're self-employed and you just did an odd job or two. If a situation like that comes up, we probably will have to talk to DOL about it. But as I also mentioned earlier, IRS heard from the members of Congress who sponsored this category that those kinds of little odd jobs should not get in the way of qualification.
Or another example, what if somebody has some kind of severance pay, or they're paid their back vacation pay that they had not taken at the end of their job, so they're going to receive something in the form of wages after their termination. Let's say that termination was at least 27 weeks ago, but they continue to receive some form of payment. How is that considered in relationship to being unemployed?
It shouldn't get in the way because the person wasn't working for that period of time, but it was part of our discussion with the DOL because we talked about severance pay and the fact that you might have something show up during the period when you were unemployed, but it related to an earlier period, and we'll just have to relate it back if it comes up in a particular case and explain that it related back.
Yeah, that might be difficult to prove without the actual kind of paycheck history.
Right. Well, and also in our discussions with them, there was also this question you alluded to earlier: is it's hard to pinpoint exactly when you stopped working for somebody, because, for example, your job can end January 31st, but you're getting paid through the end of February. Are you unemployed in February or not? And I don't think the guidance in any way addresses that, but it can be an issue going forward in some cases. If a person's been unemployed longer than 27 weeks, it becomes less of an issue. But if you're right on the line, it could come into play, and it might lead to a denial and then the need to go back and explain the facts and circumstances.
Right. One of the participants is asking me to clarify again on the deadline. So yes, the September 28th deadline is to send in an 8850 application for any employee who qualified, who was hired all the way back to 1/1/15. The only exception to that would be if they're qualifying for the new long-term unemployed category. That would only be applicable to employees hired on or after 1/1/16. But for every other category, if they have hire dates all the way back to 1/1/15, an employer would have until September 28th to mail that application to the states. Maybe let's take the last period here and talk about the future of WOTC. What is the discussion in Washington these days about tax reform? It's been a very active conversation, and how does WOTC fare under any kind of tax reform scenario?
Sure. Well, I'm glad you raised it, and tax reform is being discussed here a great deal. It's been the subject of discussion here for a number of years. But I think what may put us into a tax reform mode next year is the fact that both presidential candidates have talked about it, both of them in some detail, Hillary Clinton in more detail, and taking her view of it to begin with. Hillary Clinton ties tax reform to her infrastructure program, which is something that she has put at the top of her priority list. She would like to create employment in the country and greater economic activity. You could even call it an economic stimulus bill, the way this president called it, by dedicating around $300 billion to fixing roads, bridges, transit systems, which are in poor shape in a great many parts of the country. The way she would raise funds to pay for it, there are really two things she's thinking of. One is by floating bonds through an infrastructure bank. A lot of discussion about doing that over the past decade or so. And the other is to change the international tax system and to impose a one-time tax on accumulated foreign profits of American companies. The tax would be at a low rate, probably 8 or 9%. It would be payable over a long period of time, 8 to 10 years, something like that. And it's known as deemed repatriation. You treat those foreign profits as being brought back into the U.S. because otherwise they don't get taxed. But you treat them as being brought back into the U.S. as of a certain date, whether they're brought back or not. The companies would accept that. Many would, our global companies, because they would get a better tax system going forward where we wouldn't necessarily tax their foreign profits, or we would tax them going forward at a much lower rate than they currently are taxed at, which is 35%. As part of that, there would also be an effort to lower the corporate tax rate altogether, which is currently at 35% and is the highest corporate tax rate of any country in the OECD, which is the economic union of the Western democracies. And so there is enormous pressure to lower that rate. There is a great deal of discussion and academic writing about the possibility that the reason why some major U.S. companies are moving overseas is because they don't want to pay the 35% rate, and they'd rather be in Ireland, for example, where the corporate rate is 12.5%. So the feeling is the rate really needs to come down. You have not seen Secretary talking about the rate very much because throughout the primaries and through the convention, she ran against Bernie Sanders, who had very ardent supporters who actually wanted to raise the corporate rate. And she really didn't want to get into that discussion. But as part of a larger package early next year, she would try to lower the corporate rate. Now, that raises some challenges for us, challenges that we prepared for a long time ago in the WOTC world. And the big challenge to us is that under our budgetary system in Washington, you have to potentially offset the loss of revenue from lowering the rate. Now, some would argue that over the long term, lowering the corporate rate will bring more business into the United States, will keep American companies from leaving, and as a result, it largely pays for itself. There's a good argument to be made in that regard, but that's not the argument the budget system currently accepts. The idea is that you have to offset it or it is treated as a major loss. And the discussion of offsetting it has been a discussion of eliminating corporate expenditures. And among the expenditures are tax credits, deductions, the interest deduction, for example, and finding ways to simplify, flatten the corporate tax code to get to a lower rate. So the question then becomes, what do you keep when you eliminate expenditures to get there? Do you keep anything? There seems to be general agreement, and you saw this in the corporate tax reform plan that House Republicans issued just before their convention, that the mortgage deduction and the charitable deduction are untouchable. That those are too important and nobody's going to go near them, and certainly it's politically difficult to get rid of them. But what about WOTC? Well, about 4 or 5 years ago, our WOTC coalition, which is known as NEON, commissioned a number of studies by a professor at the Wharton School named Peter Capelli to try and explain the value of WOTC. And we have completely changed the way we look at the program. At one point, WOTC was looked at, and our lobbying was mostly with companies. And basically the message was, you know, it's a good thing to do. The corporate rate's high. If you direct us to do a good thing, in this case, hiring people who have a hard time getting into the job market because they're stigmatized, you also give us a tax credit, which has the effect economically of lowering our rate. That's not a great argument to use if what Congress is going to do is to lower the rate, because they'll simply say, we already lowered the rate, so you don't have that problem anymore. The discussion of WOTC with Peter Capelli's help is a discussion of lowering the cost of welfare, because most of our categories relate to welfare programs, whether it's TANF or food stamps. They also have an indirect impact on Medicaid, which is a very expensive program. So working with Peter Capelli, we have one study that suggests that for everybody hired under WOTC, the federal government saves, and Professor Capelli only looked at 4 programs, which were Medicaid, housing subsidies, SNAP, and TANF, that for every person hired under WOTC, the federal government saved almost $18,000 net of the cost of the credit, which is one heck of a return on investment. Then we worked on a separate analysis using only 3 programs, so we didn't use HUD, but 3 programs that the states contribute to, and they contribute to Medicaid, they contribute to TANF, and they contribute to food stamps. And the state savings were about $2 billion in the aggregate, and we have a breakdown of how much each state saves. So, and when we extrapolated those numbers over a 10-year period, we concluded on a conservative estimate that WOTC saves the federal government about $85 billion over 10 years, and the state governments combined, in welfare costs. And welfare costs are going up. They're not going down. And in fact, the cost of the food stamps program continues to climb. Almost 1 out of every 6 Americans is on food stamps at some point. So what we've done is we've changed the discussion to this really, it may be a mechanism that works through the tax code, but its real impact and its benefit is that you are moving people from welfare to work. Now, and you're reducing the cost of maintaining them. Now, there are some who believe that if you lowered the rate, you solve just about every social problem, and so you still don't need WOTC. But we also had Professor Capelli do a study for us that indicated that in order to get the stigmatized population into the job market in any significant numbers, the corporate rate would have to be cut very deeply, probably to around 15%, which we're not going to do. I don't see Congress doing that at all. And that it would take a long time. And proof of that, to a certain extent, by analogy, is the fact that we've seen over the years that even when the economy is growing at a fairly good pace, as it was during, say, the Clinton administration when economic growth was fairly robust, people in these categories still didn't get hired in record high numbers. It was still a struggle to get these people hired. So our argument as we go into the tax reform mode early next year and this fall is going to be to continue to emphasize that WOTC has a fairly unique role, way beyond the role that most tax credits and tax expenditures have. Its main purpose is not to lower the rate. Its main purpose is to get people hired who are very, very expensive for society to maintain in poverty and in welfare. In making this argument and in giving the Congress our data, we've heard a number of very good things. Some members of Congress have told us they have never had someone come in with a body of data as detailed as we've had in defending a tax provision. So we're very pleased with that. Speaker Ryan, the Speaker of the House, was incredibly impressed with this. We actually had a breakfast for him in Washington, not when he was Speaker, but a few months before when he was Chairman of the Ways and Means Committee. I had shared the data with the staff earlier, and Ryan, who's a very bright guy, actually knew what the data said. He had looked at it and he was impressed. He said, I am an advocate of yours. We need to have an anti-poverty program. This will be part of our anti-poverty program. On the Senate side, Senator Wyden, Senator Hatch, the leading senators on the Finance Committee all believe in this as well. And in the coming months, we're going to approach both presidential campaigns The Clinton campaign has a fairly large advisory on tax and fiscal issues, especially because she's going to want to do something there very quickly. Either in Brooklyn or here in Washington, we intend to brief the campaign on the value of WOTC and why it's important to the goals she wants to achieve. It's a little harder to identify the right people in the Trump campaign. They still seem to be organizing, and he's still writing his tax plan. It's in a period of revision, but when that settles down, we'll do the same. But I think what the groundwork we've laid makes it much easier to make the argument to Congress that if you're going to eliminate things to get to a lower corporate rate, WOTC is something you don't want to eliminate. In fact, if anything, when you lower the corporate rate, when you take potential revenues out of the system, you also want to lower spending. And WOTC really lowers the spending. And that's its real value. And that has really changed the way people look at WOTC. It was always popular, but it's more popular, and it's more popular now with fiscal conservatives than it ever was. And before taking your questions, the last thing I would say about this, which is proof of how this change in attitude has worked, there's a Republican congressman from Texas, from the Dallas area, named Sam Johnson. He's a former POW, very heroic guy, but very conservative and has never believed in tax credits. And you could never talk to him about WOTC. If you went in and talked to him or staff about WOTC, the conversation was very short, because he would say to you, or the staffer would say to you, we don't like tax credits. We're just not going to support any tax credits. But when you go into his office, there's a huge sign on the wall that says it's about the spending, stupid. When I sat down with him and his staffer and I went through the analysis of how WOTC changes spending, the response was, now we can talk to you about this, because we really like this. And we like the fact that this thing alters spending, which is a long-term problem. The Congressional Budget Office is estimating the next president of the United States, after the first year he or she is in office, is going to confront a major spike in spending by the federal government, unless something is done about it. So we're part of that conversation, and I think we positioned ourselves in a very good place. I think if we hadn't done the reposition of WOTC, we'd be in a very difficult place. But I think now, if you look at what Congress would keep if they were to go on a path of eliminating tax expenditures, WOTC is in a very favorable position. So that's where we are.
Great. Well, thank you for that analysis. Just a reminder, anybody who has any additional questions, I've tried to take care of the questions that came in through the text box. But if anybody has any additional questions, we have a couple more minutes. We can entertain those. Of course, you can contact me with any other questions that you think of after the presentation, and we'd be happy to get back to you with any answers. I want to really thank you, Evan, for your time today. It was a pleasure to speak with you again, as always. And I don't see any other questions coming in. So with that, we'll wish everybody a good day, and we'll hopefully hear good news in the near future. Thanks very much.
Bye.